Good afternoon, everyone. Today I'm chatting with Rick Rule. In today's interview, we discuss the Rule Symposium 2025 and what the sentiment was like with investors and what that means for those of you who like to invest in precious metals equities. We also get into Rick's process for investing in exploration and development stage companies, how he thinks about cash flows and absolute valuation, and ultimately finds a way to benchmark what he thinks stocks are worth, and it basically gives him the idea of if he wants to invest. All right, everybody, enjoy the interview. Rick, thanks for hopping on.
Pleasure. Thank you for having me back.
Now, I was just at the Rule Symposium 2025. I actually didn't see you the entire time there because it was much larger this year than last year. And I imagine you were being bombarded by people. For us, we had dozens and dozens of people come by and chat with us about how much they enjoy our content, which hasn't happened at any other conference. We've only been doing conferences for a year now. Actually, our first one was the Rule Symposium 2024. But certainly it felt like the sentiment was a lot happier this year. The conference, it seemed bigger, and I'm sure you're going to give us insights on that. So what's your thoughts if you were to tell people about how the symposium went in 2025 in terms of the sentiment and ultimately what the feeling is out there? What would you tell them?
Three critical differences. The first is that we had a very high uh, reinvestment rate in the sense that people who came in 2024 liked it well enough that they came in 2025. We didn't need to re-educate that crowd. We educated them last time. The conference, as you suggest, was larger. In particular, the live stream audience was double last year's audience. The critical difference that you noticed in terms of sentiment was in 2023 and 2024, we taught people how to think. We taught them the precious metals narrative. They were studious, but the people who came in 2024 made so much money that they were aggressive in 2025. Walking down the aisles at the conference this year, what you saw was people who had studied in 2023 and 2024 who were transacting in 2025. A critical difference. I had an attendee that came up to me this year and said, anybody who attended in 2024 who didn't make a lot of money is a moron. And I think it was the confidence born of learning the business in 2023 and 2024, where there wasn't the psychological satisfaction of seeing the share prices increase. Coming back in 2025, being up 60 or 65% a year, in some cases up 100%, that made people's reaction to the conference this year much more applied.
Now, I'm gonna ask you to pull out a crystal ball here, and I know I'm doing this kind of early in the interview, but you look forward to the Rule Symposium 2026. Do you think the sentiment is going to be overwhelmingly positive again? Obviously, this is tied to the larger question of what happens in both the equity markets and with the commodities. But what's your view right now?
I think that'll depend on the ongoing engagement of the people in the 2025 symposium. If they take the lessons and then forget them and go back to their old way of investing, which is to say, got a hunch, bet a bunch, they won't have a good experience. A market that is up by 65% is precisely 65% less cheap. You like the psychological satisfaction of higher prices, but understand that you're coming in at a higher valuation. Uh, as prices go up and you become more confident, you actually need to become more cautious. The gold stocks are not hated. So the premium that you enjoy when a sector moves from hated to unhated has already been enjoyed. It's important to note that. The people in 2024 understood the message, but they were cautious because they hadn't experienced the price rises. Now those same people have experienced the price rises and they've become more confident. They need to temper that confidence by reacquainting themselves with the lessons that they learned that enabled them to make the money. That's the difference. Blind faith, which is one result of markets that are up by 65%, is fatal. I believe, for reasons that we'll likely discuss in this interview, that over 10 years, the gold price goes up substantially from here because I believe the purchasing power of the US dollar declines. But people can be involved in a circumstance where there's a rising tide and their ship can still sink because they don't pay attention to the lessons that the market teaches. And that's my fear.
So a question just came across my Twitter feed here, and it was Triangle investor who I know you've interviewed with a bunch of times, this just he wasn't at the conference this year. I don't think I didn't see him. I saw him the previous year, but he just threw up a question on Twitter for you actually, and so I'm just gonna go ahead and ask it just because I actually think it's a really good question, which is what is the most hated commodity right now? I got my guess, but I'm curious here in terms of like investable uh, asset classes in terms of equities. What do you think is the most hated right now? And do you think that right now is a good opportunity for that?
I would have to give you an elliptical answer. I think nothing is hated, but there are some things that are unnoticed and unloved. Uh, a a stock that I like as a speculator, understand you could easily lose all your money investing in this stock, is an Australian listed issuer called Sovereign, which has a rare earth and rutile, not rare earth, I'm sorry, a rutile and graphite deposit in Malawi. Commodities that aren't hated, it's just that most people can't spell them. They aren't excited. Uh, Deposit that likely has in situ recoverable reserves and resources in excess of $20 billion in a very cheap wrapper. Lots could go wrong. And you will never get the psychological satisfaction in rutile that you would with gold or uranium. A different idea is a rare earths name that I like a lot called meteoric, a darling at the conference, frankly. But almost nobody knows anything about rare earths. There's no narrative around rare earth to match the narrative around gold, although geopolitics is becoming a narrative. But it's a large deposit in a place, Brazil, that scares people, in a deposit type that people don't understand. So there's no love associated with it. A different one would be sulfide nickels. Sulfide nickels are out of favor because they've fallen in price by 70%. And people see the threat to the nickel price that comes from lateritic nickels. I like big sulfide nickel deposits because they make a lot of money. Uh, so very, very, very high quality sulfide nickel deposits, if you're willing to wait 5 years for gratification, I think are an attractive part of the market. For investors, coal cash flow is still cheap, and oil and gas cash flow is still cheap. I wouldn't describe oil and gas as hated, but I would describe it as unloved and cheap and boring. And boring. I love boring.
So, Rick, one thing I want to ask you about, you just mentioned laterite nickel, and I have seen a little penny stock out there. I shouldn't probably even name it right now because it's so early stage, but they have a pretty massive laterite nickel deposit in the U.S. Is there any hope for that idea, or do you think that that's a little too far fetched?
No, way too far-fetched. Lateritic nickels work in weathered horizons, so you would be looking well, ideally, you'd be looking in Indonesia or the Philippines. Perhaps, you'd be looking at an undiscovered laterite in Central Africa, or in Brazil, but the ones that are really cost competitive are ones that are located on tidewater, either in the Philippines or in Indonesia. Uh, People want, a theme in a terrain that they're comfortable with. The problem is you give up economic viability for political comfort. I also probably wouldn't buy a Canadian-listed laterite nickel company because the Australians are way more efficient working in Southeast Asia where the economic laterites are.
Interesting. I haven't thought about that before in terms of uh, tying exchanges to geographical regions, but that's something you think about.
Absolutely. Uh, if you are a management team of a company operating in Indonesia and you live in Toronto, it's a long way. If you live in Perth, it's an hour and a half. Guess who has more experience in Indonesia? The guy from Perth or the guy from Toronto? You want, when you're buying a junior, you want a management team that has enjoyed success at the task at hand. If you're operating in Southeast Asia, the people who have experience at the task at hand either live in Southeast Asia or they live in Western Australia. That's the way it works. They don't live in Toronto or Vancouver. They don't live in London.
Yeah, I've always had that concern when somebody pitches me a deal, like let's say that it's a Australian based or New Zealand based gold explorer that is listed on, say, the TSX Venture. It's something that I have a hard time wrapping my head around, because you think Australia is perfectly fine at funding that opportunity. Should it be worth funding?
I'm okay, with the company that's listed in Canada, if its management team is located reasonably proximally to where their assets are. Companies believe that their cost of capital in Toronto is sometimes cheaper, particularly in the early stages, than other places, although the valuation disparity between Australia and Canada is largely gone. But what I want, irrespective of listing, is a management team whose past track record of success was in a task very similar to the task at hand. Somebody comes and pitches you and they say, I was successful in mining. Well, it turns out their success was operating a gold mine in Archean terrain in French speaking Quebec, right? What they're proposing to do now is explore rather than produce for copper gold porphyries in 15 million year old accreted terrain rather than 2 billion year old Archean terrain in Spanish speaking Peru. The success that they enjoyed in the past is not germane to the task at hand. And so, what I want is a management team that has enjoyed success in a task that's very closely related to the task at hand. If the CEO of my company is proposing to explore for laterite nickels, I want to know that they've enjoyed success exploring for laterite nickels. If they are exploring in Kalimantan or Sulawesi or Mindanao, I want them to have explored in Kalimantan or Sulawesi or Mindanao. I don't believe that experience gathered in Morocco is necessarily transferable to British Columbia, irrespective of the domicile.
You mentioned Morocco, one of the companies that was I believe that they were a presenter, and they had a booth at the conference, was Aya Gold and Silver. I've seen a few plays in Morocco. Either Morocco is on the cusp of being a really attractive jurisdiction to be investing, or everyone that's trying to sell this to me is wrong. What's your take on it?
Well, the company in question, Aya Gold and Silver, uh, is partly a management play. I've invested with Benoit LaSalle now for 25 years, and he's a superior human being. In addition to being successful throughout French West Africa, he's been involved in Moroccan exploration for 15 years. It's like he worked 15 years to be an overnight success. Uh, he's very good at taking old mining districts that have never been exploited with modern technology, consolidating them, spending the money that's necessary to spend on exploration, building the deposit, and working well with local communities. Note, because I enjoyed such success with him in Semaphore, his prior effort, I was inclined to believe in him because he had explored in Morocco for 15 years. It's worthy to note he hadn't produced in Morocco until 5 years ago, but he was familiar with the culture. He had 15 years experience in country. He was able to hire an in-country team that had worked for him outside the country. His success was at least partially related to the task at hand. As for Morocco, there's many ways there's many forms of mineralization, but one thing that you can think of that I've thought for years is that it's a functional part of it's a functional extension of the Iberian, um, metallogenic belt. Uh, the metallogenic belt that's given rise to the wonderful deposits in Spain, Rio Tinto and other districts. The high Atlas Mountains have a history of mineral production, although the country is very unexplored. And there's a mining culture, given that a substantial portion of the government's revenue comes from the Moroccan phosphate industry, which is the largest and lowest cost phosphate uh, domicile in the world. Could things go wrong? Sure. Yeah. I mean, absolutely things could go wrong. But as we've learned, things can go wrong in the United States and Canada too. It's just you have a lower entry price in Morocco.
I always find it fascinating just because I've Benoit was selling me on Morocco, and I've made some private investments in a couple of things in Morocco. And what I keep hearing, the feedback I keep hearing, and from Benoit included, is that there is the government right now is just really easy to work with, and they're finding permitting to be much easier than other places. So I'm kind of fascinated to see if his ramp up goes as they're guiding to, if that's going to become one of those hot areas that here in Canada, we're going to see a whole bunch of publicly traded deals in shortly.
Oh, you probably will, but you'll only have one Benoit LaSalle. He will enjoy better success in Morocco because he's a better human being. Let me give you an example. A year ago, there was an earthquake in the high Atlas Mountains in Morocco, where his existing mine is and where his new production will come from. And because the mine was well constructed, there was no substantial damage from the earthquake. Although I suspect being underground during an earthquake is an interesting experience. Anyway, what Benoit did was he shut the mine down, despite the fact that there was no damage, and he sent his workforce home, saying, "Your villages have been demolished. Look after your family. Don't worry about the mine. The government can't get up here with earth-moving equipment. They can't get up here with electricians. We have all those things. Let us know what you need to restore your villages so that you're not worried about your families." Probably cost uh, shareholders 6 or 8 million bucks, but I would suggest it bought a generation of loyalty. What that means is in terms of dealing with the government, Benoit is gonna have an advantage over the next 10 years that some moron running a TSX venture company who failed in BC and failed in Tasmania will not enjoy in Morocco. When you think about jurisdictions, you need to think about the durable competitive advantage that your management team has in that jurisdiction. Otherwise, there is no jurisdictional advantage.
I want to ask you about, as we see capital start to flow into mining names, which we've seen over the last years. You've mentioned a lot of them have experienced over 50% gains. Uh, does relative valuation start to play a bigger factor in how you look at things, where we start to see more of a real price discovery in an environment where there's more capital flowing in?
I look at absolute values first before I look at relative values. I need to say that. And if you look at absolute values on the TSXV, what you learn is that 85% of the issuers have no absolute value. So some of the crap is less overpriced than some of the rest of the crap. But the first thing that you need to do is understand that fully 85% of the listings have no net present value whatsoever. Doesn't mean they won't go up. It just means that they're worth nothing. That's the most important first realization. What happens in a bull market is that companies that are worth nothing go from a $5 million valuation to a $20 million valuation. Uh, if a $20 million piece of crap is overvalued relative to a $10 million piece of crap, the most important thing that you have to remember as a speculator is that both of them are worth nothing. And you need to concentrate your efforts on companies that stand a chance. Absolute valuation is a much more important guarantee of investment success than relative valuation.
How does a substantially higher gold price than, say, 5 years ago impact your view on gold equities? Like are some of these names where people said, okay, uh, the Golden Triangle, for example, I'll throw out there, where a lot of those areas are kind of considered pretty remote, and the capital expenditures just to get them up and operating was considered to be such an astronomical number that nobody was going to want to touch. Do you start to look for those as your torquey place when we get into that sort of $3,500 gold environment, and
Much
we
less
see
than I
that
used
margin
to.
expansion?
Much less than I used to. In the early 1990s, nobody paid for optionality. It was free. When Rudy Frank built Seabridge, he acquired KSM for $300,000. Nobody paid for optionality. When we built Vista, we could buy ounces in the ground for $1 an ounce. They were worth nothing on a net present value basis, but you got the optionality for free. When Ross Beatty built Lumina, you could buy copper deposits that majors had spent $90 million on. You could buy them for $2 million. Optionality has a price tag associated with it now, so I'm less attracted to it. That doesn't mean that these things won't trade up. What it means is that optionality was a better deal when you got it for free. It's a less good deal now. Now, if you're looking at real gold companies as opposed to the pretenders, let's look at Agnico Eagle, a boring stock. I love boredom. Back of the envelope calculation, if you do a net present value on Agnico Eagle and you use a $3,300 gold price and you model the cash flows out 5 years, 10 years at today's prices and costs, the stock is actually cheaper relative to $3,300 gold than Agnico was at half this price 18 months ago with $2,200 gold. Because if you use 2,200 as the baseline for doing a net present value calculation, the net present value number that you get is materially lower than you get if you use 3,350 as a baseline. For real gold companies, the leverage to the gold price, which you enjoy next year, next month, is much higher than the real optionality you get on gold price on the gold price for deposits that may never go into production. Or if they do, will go into production at a gold price scenario, which could be materially higher or lower than today. What will change is the stupidity of investment markets and the willingness of speculators to overpay. A deposit with the average grade of seawater that has some gold and has fairly high upfront capital costs will come to be valued in the market on an in situ value per ounce metric, which from an investment point of view is entirely irrelevant, but will matter to speculators. There was a time in my youth when I thought I was smart enough that I could trade against the expected stupidity of my counterparties. I don't do that anymore. I do absolute valuation. I'm uninterested in monetizing fiction.
So when you say absolute valuation, I mean, I imagine for a lot of the companies, look, a lot of the companies that were at the conference, they are still, exploration or development stage where it's not exactly easy to model out 25 years of cash flow or 13 years of cash flow and then go and discount it. How do you look at absolute valuation then when it's so hard to predict exactly what that looks like?
Uh, in a thumbnail, investment calculations are the delta between the enterprise value of the company and your estimate of its net asset value from proven, measured, indicated, and inferred ounces that you believe are certain to be in production within the 8-year time frame. In the exploration companies, you are modeling the probability that what will become the net present value of the asset 5 years from now is materially higher than the enterprise value today. That's a process of anticipating and uh, measuring the probabilities of the answering of unanswered questions over time. If the company's target, you think 5 years from now, will have a net present value of $1 billion, and the market capitalization of the Explorer today is $50 million, you need to decide what is the process by which the market gets certain of that $1 billion valuation. And what is the probability of the successful completion of every unanswered question in the process between here and there? It might be that for an exploration stage company, that they have a large mineralized anomaly in northwestern BC. They've done surface sampling, grab sampling, by nature selective, and they've outlined a large mineralized anomaly. The first question might be, is that transported gold, or is it in situ? And to answer that question, they might need to do a trenching program to see that the gold extends through soils into bedrock. And it might be that they need to do an extensive trenching program. That would be the first unanswered question. In other words, is this mineralized anomaly ubiquitously mineralized, and is it mineralized at depth? And you would try to gauge A, from the experience of the people asking the questions, and B, from the nature of the surface sampling program they did, what's the probability that the trenching program will give them a drillable anomaly? And it might be that you decide that it's highly likely that this will occur. Highly likely. And so you will speculate on a yes answer. Let's assume you get a yes answer now. You have refined your knowledge of this thing from selective grab samples to systematic trenching, and you have a legitimate mineralized anomaly. Now you need to test the third dimension. You need to say, does this extend to depth? And what does the grade profile look like at depth? So it might be that you propose to test this with a 10-hole drilling program. Again, you as a speculator need to look at what a yes answer is worth. In other words, if they have a reasonably successful 10-hole drilling program and they define a resource, which hasn't been measured or indicated, but they've defined a resource, what is the market likely to pay for that? And what is the probability of success likely to be? So let's say, just for fun, that you have a 10-hole program, which turns out to be a success. Then the next thing might be, okay, so now we need to drill it off systematically. We need to test depth extension, strike extension, width extension, and depth. In other words, we need to develop a target size. We need to begin to move into the PEA status. And that might be a 50-hole program. Again, you try to determine what the yes answer is worth and what the probability of achieving that yes answer is. Mercifully for me, most of my competitors are unwilling to do all that. Most of my competitors pursue a strategy called "got a hunch, bet a bunch."
I'm happy you're mentioning this because this is what I find fascinating. So we're talking about, say, a company. You're estimating, okay, what's the probability of $1 billion net present value? You peg it at 25%. Okay, 250 million. There's obviously some more math you can do on that to maybe say make it 350 million. I don't know. Okay. The company's market cap trades at 50 million right now. Now, to do all this work to get it to that $1 billion MPV is going to require a lot of money. And of course, the thing that you got to think about is when you talk about market cap, you're talking about dilution, which means that the shares outstanding that exist today will not be the same that exist in 5 years. So how do you think about that? And specifically, when you're saying how you sit and do the work and other people don't, does that mean that you sit with a team and you guys like have a whiteboard in front of you guys and you guys are mapping it out? Or do you just have like a financial models that you use? What does that framework look like?
Yes and yes. Let's look at every stage. Let's say that we have a large, what we think is a mineralized anomaly, and we're going to have to do a sampling program. Uh, and let's say that this is in northern BC, so that your field season is very short. In Nevada, uh, where your field season is long, you might be able to get that work done in 1 year. But in northern BC, it's going to take you 2 years. So the first thing is you try and determine how much the program's going to cost. Let's say it's $1.5 million, because you got to fly the tractors in, you got to fly the fuel in. Uh, uh, and let's say that it costs the company $1 million a year in G&A to stay alive. So in order to get the yes answer, they got to raise $1.5 million for the work program and $2 million a year for the G&A. They need $3.5 million. So let's say you look at the company and they got $1 million in the treasury. So you got to say to the management team, if you're successful, then you validated a target and the company's going to be worth much more. The problem is that you don't have enough money. Now, always the guy says, I got access to money. I could do this. It's one of the reasons I'm talking to you. Really? Yeah. I mean, Peter Brown's going to give me the money. I say, oh, I know Peter. I'll call him. In other words, trust but verify. Uh, and what you got to do, in addition to that, is that you have to adjust your own time frames. If it's going to take 2 field seasons, a year and a half to get a yes answer, you got to be prepared to hold the stock for a year and a half. And that's where people break down. They have an excellent thesis. This has the hallmarks of a good exploration program. And if they're successful, the stock's going to go up. They don't juxtapose the fact that in order for that to happen, they need to wait a year and a half because they have trauma themselves holding stock over a long weekend. In other words, their holding period precludes the probability that they could be successful.
So I'm just trying to think about this from a framework decision. Then you're trying to look at all of the steps that are going to be required to get to that PEA where you're going to get that net asset value. You then have to think about just the amount of money that's going to have to be raised. Does that mean that when you're doing your modeling, are you assuming that you're going to get some sort of bump in price for each of these stages being successful, and that's sort of how your
You might
dilution
or might
calculations
not.
work?
You might or might not, but you're going to get a bump in value. Price follows value over time. I'm not talking about narrative. Narrative, which is to say the willingness of the market to overpay or underpay, is something beyond your control. What I'm talking about is if the market cap today substantially understates the value, not the price, that will accrue to you from a yes answer on a probabilistic basis, then you can speculate. If you don't have enough knowledge to do that, um, you should do something sensible with your money.
Now, let me ask you this, and this will be my last question for this, and you've been generous with your time. Do you have a discount that you need to move forward when you do your calculations? Like, I assume that you're not, okay, like, I think that the value is this, that it's trading at this, it's below that. Let's give it a shot. I imagine you're looking for some sort of a discount in order to want to move forward.
I traditionally run 3 valuation models, knowing that they're all wrong because this is all probabilistic. The market for gold companies uses a 5% discount. The rationale for this is that gold itself is an inflation hedge, and so you don't need to discount a discounter. Uh, it's also because if you use a higher discount rate for most gold projects, they become uneconomic, and the investment bank that generated the research report can't get a fee. Um, that's the cynical explanation. Buy-side investors right now are using discount rates between 8 and 10, understanding that their discount rate isn't gonna be reflected in the market. So I run a 5 case and I run an 8 case. And within those cases, I run a pricing scenario at the forward strip, which is to say at market. At a 25 I run a stress test at a 25% discount, and I run an upside case, at a 25% premium in terms of commodity prices. I also run my own case, which has nothing to do with the market, where the discount rate that I use is the implied cost of capital of the issuer. For non-investment grade project finance, construction finance, currently the cost of debt capital in the market is 15%. So arguably on an enterprise level, the correct discount rate should be the cost of capital of the issuer. Now understand, if you run a 15% case, your net asset value is going to be substantially below the net asset value that's going to be ascribed by the investment banks to the universe of mining stocks. And so you need to take into account apples to apples calculations. That's why I always run 3 different discount scenarios and at least 3 different commodity price scenarios. I know that each of my net present value calculations is wrong. I just know I get much closer than people who don't do one. I'm not searching for perfection. I joke that even an old fat guy like me could win the 100-meter dash if I'm the only guy shows up to run.
All right. Well, Rick, let's leave it at that. You've been generous with your time, like I said, and you're actually in incredible shape for somebody your age. So I appreciate the modesty, but having seen you in person, I can tell you hit the gym a few times a week.
I do
Uh,
spend some time in the gym. Yep.
but thanks so much for doing this. It's always a pleasure, and thanks for inviting us to the Rule Symposium 2025. We had a great time, and we got to meet a whole bunch of people who watch our content every day, and that was really special for us. So we really
I
appreciate you
should
having us
I
there.
should tell your audience, those who weren't at the symposium, that the information is timeless and the recordings are for sale, after the event. And if you buy the recordings and you think for any reason whatsoever that I didn't deliver value, I'll give you your money back. Money back guarantee. Rural Symposium, uh, 2025 tapes. They are available, they are cheap, and there's a full money back guarantee.
And to get those, they go to which website?
You can go to the Rural Classroom or you can go to ruralsymposium.com.
Okay, we'll put that on the screen at the bottom. All right, Rick. Thanks so much for doing this. Always a pleasure. Let's do this again in maybe next quarter, where you can update us on how everything's going in the market.
Look forward to it. Thank you.
All right, everybody. Thank you for watching. If you enjoyed this conversation, please do me a favor. Smash that like button, subscribe, and ring that notification bell. All right, everybody. Thanks for watching.